Hi, I'm Mark Santero, CEO of Homestead Advisors, and I'm here this morning with Mauricio Agudelo, who's head of our fixed income department. And we're going to shoot this really to touch base on how the Fed reacted and what the markets think about yesterday's announcement. And we learned that they're holding steady at 5.25 to 5.50, which was Wednesday, June 12th. So for the seventh consecutive meeting, we have pause. No surprise, I'm assuming. And what are your thoughts on the Fed's announcement yesterday?
Yes, Mark, that's correct. The Fed held rates steady for the seventh consecutive time. That was no surprise to the market. What really we learned from the meeting yesterday, the Fed released their dot plot, or the statement of economic projections, where they anticipate now only one cut in 2024. They are expecting 4 cuts in 2025 and 4 cuts in 2026. So that moved from a prior 3 rate cuts in 2024. So they deliver a slightly hawkish tilt. That being said, during the press conference, Chairman Powell emphasized that it was a close call between 1 or 2 cuts for the balance of the year.
So we started the year with the Wall Street analysts and basically saying or pricing in 6 cuts, and now we're down to 1 cut. How have the markets reacted to the 7th consecutive pause? Now going from 3 to 2, we were 3 in March, now we're down to 1, How have the markets responded?
I think you're right. At the beginning of the year, the market came in expecting 6 to 7 cuts. Inflation, as we saw in the first quarter, we saw a slight uptick in inflation, and that repriced the market expectations for rate cuts for this year. We have seen some increased volatility in the Treasury market, in particular, as the market tries to digest and balance out expectations for rate cuts versus the message that the Fed is delivering. I believe the Fed is taking a cautious approach. They want to balance how tight policy remains down the road, but at the same time, they don't want to cut too soon, risking an uptick in inflation in 2025, 2026.
Well, you touched on inflation, and the economy in general is still strong in the U.S. I mean, the World Bank came out yesterday saying the U.S. is really leading the resurgence in Europe and outperforming China. But the latest data that just came out in the last week indicates that inflation is easing. So the higher, longer strategy, is there concern that they missed it on the way in, where they took too long to start hiking rates? Is there the concern that maybe they're going to miss it on the way out?
What you're really touching on here is on the issue of credibility for the Fed, which was really questioned at the beginning of the rate hiking cycle because of how late they were to react. At this point, they are taking in my opinion, a balanced approach to data. They want to see sustained progress towards the 2% inflation mandate, and we are by looking at PCE, you're around 2.7, 2.8. The Fed and Chairman Powell emphasized yesterday that they want to get to 2%, and they want to see sustained progress towards that goal. The CPI release yesterday morning, it's an encouraging sign. We saw components of core CPI that should certainly give the Fed comfort that we are getting towards that goal. and they could potentially cut once or twice this year. You're looking potentially at a cut in September, potentially another cut in December, and taking a wait and see approach to the incoming data.
I mean, everyone thought we were on the road to a recession, but they have so far had the soft landing that no one thought that they can pull off. And one of the signs for a recession is an inverted yield curve. And we've had the 2-year out, yield over the 10-year for coming up on almost 2 years now. I know I'm going to put you on the spot, but any thoughts on when we might see that pivot from a more normalized yield environment?
You could potentially see a more normalized yield environment at that point when the first rate cut takes place. Will that be in the third quarter of this year? Will that be in the fourth quarter of this year? That remains to be seen.
Okay, so the pivot will happen when we see the first cut. I won't hold you to it, but I might. So, are there any major concerns, events that might deviate from the Fed policy? Barring any black swan events. A lot of our investors ask, will the election sway the Fed? Will any of the geopolitical issues sway the Fed? Or is it really all about inflation and keeping it down?
One thing, in my opinion, to keep an eye on is the labor market. We have seen a decline in job openings. Mm-hmm. We have seen a slight uptick in initial jobless claims. We have seen unemployment, tick up now around 4%, which is actually where the Fed is expecting unemployment to be at the end of this year.
That's pre-pandemic, pretty much pre-pandemic levels.
Pre-pandemic levels, mm-hmm. Right? So, we need to keep an eye on the employment picture. Additionally, when we look overseas at other central banks, mm-hmm. the ECB cut rates. Right.
And Canada, I believe, is close.
So other central banks are already cutting or mm-hmm. getting close to cutting. Mm-hmm. So could we potentially have a slowdown overseas that has some ramifications for U.S. markets and U.S. economy? Possibly.
Okay. Last question. What can we expect from the fixed income markets for the remainder of the year and into 25 with one rate cut and then potentially 4 next year?
I think the fixed income market is a great place right now from the standpoint that we have yield, we have coupon. We are coming off a decade of zero interest mm-hmm. rate policy. So for investors, you are getting paid, to own fixed income at this point. You are clipping that coupon. Credit spreads right now are on the tighter end of the range. And we expect, the front end of the curve to outperform in the next, 12 to 18 months.
Great. Well, thank you very much and appreciate it. And to all our investors, if you have any questions, please go to our website, homesteadfunds.com. Thank you very much.
Thank you.